Have you ever made one of these investing mistakes? Most people have, even without realizing it. And trust me, mistake number 5 is the one that quietly destroys portfolios over time. Let's start at the top. Mistake number 1. Trying to time the market. Everyone dreams of buying at the bottom and selling at the top. But even professionals with decades of experience fail at this consistently. The reality is that markets move in unpredictable bursts. If you sit on the sidelines waiting for the perfect entry, you often miss the biggest up days that drive long-term returns. Instead of timing, focus on time in the market. Dollar cost averaging, steady contributions, and patience beat crystal ball guessing every time. But timing isn't the only trap. Mistake number 2 is ignoring diversification. Putting all your money into one stock, one sector, or even one country leaves you exposed to unnecessary risk. Tech stocks can soar, but they can also crash. Real estate investment trusts can pay high yields, but they can collapse when rates rise. A diversified portfolio across stocks, bonds, ETFs, and even some international exposure cushions you when one area stumbles. Diversification doesn't eliminate risk, but it prevents one bad bet from wiping you out. Now here's where many investors slip up. Mistake number 3 is letting emotions drive decisions. Fear and greed are the 2 most expensive emotions in finance. Panic selling during a downturn locks in losses, while chasing hype stocks at the top often leads to painful drawdowns. Think back to meme stocks or cryptomanias. Many who bought late are still underwater. The antidote is discipline. Have a plan, stick to it, and remember that volatility is normal. The market rewards patience, not panic. Before we get to mistake number 4, which is one of the most subtle but devastating, let me pause for a quick note. If you're finding this breakdown valuable, hit that subscribe button to join us here at Stocks and Crypto Insiders by NENC. We post weekly deep dives to help you navigate markets with clarity. And drop a comment below. Which of these mistakes have you seen friends, or even yourself fall into? Your stories help others learn too. Alright, mistake number 4. Underestimating the impact of fees and costs. This one doesn't feel dramatic in the short term, but over decades, it's a silent killer of wealth. A fund charging 2% annually might not sound like much, but on a €10,000 investment over 30 years, that fee drag can cost you tens of thousands in lost compounding. Even frequent trading racks up hidden costs. Smart investors obsess over minimizing fees, choosing low-cost ETFs, avoiding unnecessary churn, and letting compounding work without friction. And finally, mistake number 5, which might be the most dangerous of all, not having a clear plan. Too many investors jump in without defining their goals, risk tolerance, or time horizon. Are you investing for retirement in 30 years? Or for a house in 5? Those require very different strategies. Without a plan, you're vulnerable to every headline, every hot tip, every emotional swing. A written plan acts like a compass. It keeps you steady when markets get stormy. So let's recap quickly. Trying to time the market, ignoring diversification, letting emotions rule, underestimating fees, and investing without a plan. These are the 5 mistakes that drain portfolios and derail financial goals. The good news? Every one of them is avoidable. With discipline, patience, and awareness, you can sidestep these traps and let compounding do the heavy lifting. Thanks for watching. This is Stocks and Crypto Insiders by NENC. If you found this useful, give it a like, share it with someone who needs to hear it, and subscribe for next week's deep dive. Until then, invest smart, stay disciplined, and avoid these mistakes.